A fresh wave of concern has swept through markets today after the U.S. House of Representatives passed a major tax cut bill, one that analysts say could add trillions to America's debt. That's already pushing Treasury yields higher, which could see a rise in borrowing costs across the economy and rattle investor confidence. Now, to unpack what this means for gold, the dollar, and market sentiment, I'm joined now by veteran market analyst John Eng of Mason Placements in Canada. John, thanks very much indeed for your time.
Good to be here.
John, let's start with the passing of that tax bill in the United States. I mean, of course, as you've mentioned, as you flagged before, fears of a swelling debt number are now increasing. What's your take on the signing of that bill?
Well, it's interesting to note that just before the bill was passed by the House, that Moody's downgraded at long last America's debt. What I've been I and others have been saying is the problem with the tariffs, Trump's tariffs, is that it imposes a huge inflationary cost. But most important, the bill itself adds about anywhere between $3 to $5 trillion to America's debt. America has the largest debt in the world at $37 trillion. And this so-called tax cut bill adds debt, and it exacerbates the problem. And the problem, frankly, is because America depends on outsiders to fund their debt. And the problem is that they have also penalized outsiders, those very countries that buy U.S. treasuries. They slap tariffs on it or threaten to slap tariffs on it. And that has obviously worked against America. So today, in fact, we have the 10-year treasuries higher than Liberation Day. So that, of course, sparked a 20% sell-off in the market. So the problem is America's debt, and they don't seem to want to solve that problem.
All right, let's talk about, the impact of all of this on the metals here, right? Gold briefly hitting a 2-week high before slipping below that $3,300 mark as investors booked the profits. Now, you've argued in your report that you released recently that this is just the beginning of a longer bull run. But now, given the debt-driven risks and dollar volatility, do you still believe $4,000 on gold is on the cards this year?
Well, trees don't grow to the sky, but there's no question that $4,000 is a realistic target. I can recall when $100 was the target. We must remember that gold in the early 70s went from $35 to $850. That was something like a 2,300% move. And then in 2011, I can recall it went from $250 odd to $1,900. That in itself was a 653% move. Since 1900 to today, we've only gone up about 84%. So there's no question about the ingredients that are propelling gold higher are very much there. The problem is America's deficit. They monetize that deficit. They want to continue spending. They are hurting the dollar with the tariffs, and they're threatening to annex other countries. All of that undermines confidence in U.S. assets. What's going on today is to sell America, and that's hurting them.
Yeah, so much of that is based on sentiment, as you allude to. I mean, let's talk about what the White House just announced earlier today. President Donald Trump confirming his attendance at the G7 summit in Canada next month. You spoke a lot about sentiment. Do you expect markets, particularly gold and mining stocks, to react to what may come out of that G17 or G7 meeting? And what do you think of the fact that he's now committed to attend?
Well, the only certainty about Mr. Trump is uncertainty. And the sentiment, there's no question about it. But no one really knows, probably including Mr. Trump, what the next 6 months look like. And the markets just abhor uncertainty. And we have a lot of uncertainty, everything from the tariffs to what's next, to the executive orders, to what's going to be tested. There is just big question marks. And business companies don't like it. And the reality is that the best Trump trade is gold. Gold is fungible. It's a universal asset. It's an alternative to the dollar. The US dollar now is not the currency. It's fallen 10% and threatens to stay below 100. I mean, it's ironic that Mr. Trump wanted a lower dollar, and he was talking about manipulating it down as they did in 1985. But today, the dollar's coming down just with his own moves. So there's no question in my mind that a lower dollar is in the offing, but that's also inflationary. And that makes the Fed secretary, really big problems with respect to interest rates. And if you have a combination of high interest rates, climbing U.S. debt, that does not bode well. They are spending $1 trillion today just on interest costs alone. Borrowing costs are hurting the Americans.
Yeah. We were speaking about gold, but let's talk silver for a second here. That's an interesting one. $33.70 on Wednesday, its highest level in 7 weeks. But I see today some signs of near-term fatigue creeping in. What's your take on that metal?
The problem with silver is that because it's not a monetary metal, has been in the past, America, China, and that, but silver is itself used as a byproduct. So they will go up. Rising tide lifts all boats, but they will not do as well as gold.
John, I really wanted to get your take on some of the news coming out here, that two of the world's largest iron ore miners are replacing key executives. You've got Rio Tinto's Jakob Stolzholm announcing he was resigning. An hour before that, Fortescue said its energy chief, Mark Hutchinson, would step down. I mean, these are two big iron ore players. You think they will have any ripple effects on the market here?
Oh, there's no question about it. Iron ore, there's no shortage of iron ore in the world. It's sort of like gold. It's dependent on price. And you have the big gorilla, China, which is a big consumer. And then you have the production coming out from Brazil, Australia. And the problem is it's a low margin commodity and tied to the industry and that. And so there's a lot of pressures now. Mining is now gone into what we're getting is big is best, and particularly in the major commodity, industrial commodity business like iron ore. The gold companies, in a way, are trying to emulate that. The problem is that you got to run a lot of mines around the world with conflicting governments, with different jurisdictions, and yes, that's pressuring. So to be in the saddle of one of these big miners is a very difficult job, and yeah, burnout is very high.
All right. And as we wrap up, John, I mean, any major events, forthcoming events over the next week or so in the near term that you think is going to really impact and change course on any of the big market movers, particularly for the metals? What do you got your eye on?
Well, I think politically, it's the bill that down in the States has got to pass the Senate, and there's a small margin there. So we're going to get the to and froing, and that will dominate the news cycle for the next week or so.
All right, we'll leave it there. Well, thanks very much indeed, market analyst John Eng of Mason Placements Canada. Thanks indeed for your time, John.
Good to be here.